Well, hello everybody, and welcome to the last episode of the ESG and Tech Show in this year 2022. It is Susan Hayes Culleton here with you, and I'm delighted to be here and to share insights with you about what I think might be coming down the tracks in 2023. Now, over the past year, we have talked about a lot on the show. We've spoken about blockchain, we've spoken about various different technologies, and of course, we've talked about what has happened this year in technology in the stock market. It has been a very, very tough year. If you have been a tech investor, and if you look at what the S&P 500 has delivered to, of course, the downside, and you compare that to what the tech sector has delivered further to the downside, it has been a particularly tough one. So what I'd like to do today is take a look at the technologies that look like they're up and coming for 2023 so that we can get an insight into where this might be the case. However, because the market has had such a remarkable year of a downturn, primarily driven by inflation and the following reactions to it, whether it was a rise in interest rate, whether it was the increasing relentless pace of inflation, of course, a big driver of that has been energy as well, or of course, where it has come from an understanding or an expectation of a global recession of sorts, and then we saw the tech stocks actually selling off. Sorry, not selling off; they did that too, but laying off people as well around the world. Of course, that also had another impact as well. From the sustainability side, there has been lots of new developments. Again, the price of energy has driven countries to particularly focus on its clean energy agendas. We've seen more of a drive as well from individuals, whether that comes from electric vehicle purchases or their own putting money as well into ESG funds and funds flow. We've seen a lot of that happen. But again, what I'm going to do is come back to what's really driving 2023, or what's set to drive 2023 as well. Now, in addition today, what I do want to do is look at the overall market. I'm just going to look at the market quite briefly and get an understanding of where the US market is currently sitting from a broad brushstrokes. And then after that, we will get into the trends driving 2023. And then there we will narrow it right down to both technology as well as ESG. And I'm going to good sources, insights about those. Okay, so as we usually do, as always, will you please just let me know there in the chat where you are tuning in from? It's all I always love seeing it. I always love to see where people are joining us from. So will you just pop it there into the chat? Let me know what part of the world, whether you're looking at this online, live right here on the 21st of December. I have to check the date there. Or whether you are somebody who's watching this and watching the recording on YouTube afterwards. Okay, first of all, we have Christian who is joining us from Belgium. Hello, Christian. You're very welcome. I actually interviewed Christian for one of our VectorVest webinars in Europe, so I know exactly who's joining us here today, which is super. We also have Roger, and Roger is joining us from Blacksburg in Virginia in the US. Anytime I start this conversation off, of course, often what I like to see is competition between me and the places that come up here to see if I've been there. And indeed, Roger, I have been to Virginia. Lovely, lovely state. John Boston is joining us from Boston, Massachusetts. Again, Justin, I've been there gratefully as well. Another lovely, not just city, but lovely parts of the world, a lovely state as well. So of course, please do keep your comments coming about where you're tuning in from. It's coming up over here on the very right hand side of my screen, so I'll take a look at it and I'll be able to give you a shout out. And of course, please do, of course, feel free to pop in your questions, your comments, etc. as well. That's also what I'm only delighted here to do. I personally am in Cork in Ireland for this part or for this week. It's always lovely to be able to come home. This is the area that I grew up in. So that is where I'm tuning in with you here or beaming live from Cork in Ireland. So make sure as well. I just want to make sure on behalf of everyone in Cork that you all know that you're very welcome. Ashok has said that he is joining us from Jacksonville, Florida. Been to Florida indeed, Ashok, but I have not been to Jacksonville. Tim is joining us from Canada. Brecht is joining us from Seoul. And Christian says a nice Christmas tree. Oh, that's good. It's actually my friend's Christmas tree as well. Christian, I'm in her house, so I will make sure and pass the compliment to her. It's not a background, it's a real one. I could make it move from here. So, well, now let's get right in then and let's have a chat about what we're going to discuss today. Let's first of all get a sense of where the market is at. We've had another confirmed down call in the US. I'm going to take a look at what is going on in the market at the moment. And then from there, the first piece of research that I'm going to show you is coming from the US as well, broadly speaking, about inflation, interest rates, etc. And what I want to do, because I rarely hear people actually explaining how this works, I want to explain to you why rising interest rates have an impact on stock prices. I want to make sure and do that with you today because often that relationship or that connection, the influence that has one has on the other isn't often explained. So I'd like to do that. Then we are going to move in and take a look at what one particular party is, namely JP Morgan, is predicting around fundamentals. And what I want to do is take a statement like what I'm going to show you JP Morgan is saying, and then put it to the test in because that's what's important. It's so key that you're able to distinguish noise from news. And that is why I want to show you how to take something like what I'm going to show you and transfer it across. Moving on from there, I'm then going to split into both sides of our ESG and Tech Show. I'm going to first of all look at ESG. I'm going to show you a piece. I'm going to reference a piece that came out from Bloomberg during the last 2 weeks, all around trends in ESG that I'm going to talk to you about. And interestingly, well, the fact that we have some people from Belgium here, because one of the trends that's happening, continues to happen, is the growth of ESG within Europe instead of, well, leading the world. I'm going to be mentioning that. And then what I'm going to finish up on are the 5 key innovations that we're seeing that are sustainable technologies that we're seeing leading us into 2023. Okay, so what's the word I'm looking for? Fasten your seatbelts and settle in for all of the above. Okay, so what I'm going to do now is I'm going to hop across over here and take a look at the program. And right up here now, I have got the US program in front of me, and I want to first of all draw your attention to what happened last week. So here you can see, for example, the MTI was small for you to see here for a start. So let me open that up. Now, the MTI, for any of you who are not familiar, the MTI is the market timing indicator that we have right here at VectorVest. It's very simple to read this. Above 1 is favorable, below 1 is unfavorable. In other words, above 1 is when we see the market is rising and it has got the buyers that are driving the momentum. And of course, below 1 is when we see opposite. So that's the way we read it. Above 1 is favorable, below 1 is unfavorable. Now, as you can see, since the 10th of November, we have been seeing the MTI above 1, consistently above 1, growing all the way up here to the 2nd of December when it got up to 1.48. Again, for anyone who's unfamiliar, the maximum that it can go to is 2. Then we have now started to see it fall. And as of The 16th of December, last Friday, we saw it hitting one, and now, as you can see, it has fallen below. Why is that? Well, because of the tough stance that the Fed has come out by saying that, of course, due to the impact of interest rates, we have now seen inflation to start slightly taper off. I'll explain a lot more about that when we get into our first source. But they do say that they are not expecting to hold off on further interest rate increases. So as a result, of course, the market has been spooked by that. So we saw the MTI, the market timing indicator, go below one. If you come over here onto my color guard, and out here, go to the color guard, you can see that it was last Thursday, 15th of December over here, last Thursday, was when there was also a confirmed down call issued. Now, a confirmed down call, it happens when two things happen. Number one is that the BSR falls below one. Now, the BSR is the buy sell ratio. The buy sell ratio is the number of buy recommendations that is in the database versus sell recommendations in the database. So you can see over here that on the 14th of December, namely the day before, Wednesday, for every sell recommendation, there was 1.29 buy recommendation. However, when we go to the 15th of December, that fell below it. And instead, the buy sell ratio was at 0.76. That means that for every sell recommendation in the database, there is only 0.76 buys. Again, said another way, that means there are actually more sell recommendations in the database than buy recommendations. That's one of the key conditions that needs to happen for a confirmed down call. On the other hand, we also look to see where, in the case of confirmed down call, is that the market is down week over week for 2 consecutive weeks. So when I would compare on 15th here, so if I go back 15, so let me go back 5 days, so 1, 5, here you go. On the 8th of December, the market was at 55.62, and on the 15th of December, it was at 54.71. So as you can see there, the market had fallen in that week over week. Now, if I went back another 5 trading days again, which is another time, then it would have fallen another 5 days. And unless that condition is met, then a confirmed down call can't be issued. So as you can see here, we have got a confirmed down call, which is telling us, unless we see any change between now and the end of the year, the end of the trading year, it looks like we're heading into 2023 on a confirmed down call. Question that I would ask for you is, oh, I was just looking there at the comments that's come in. Thanks to the guys who've just posted that. From there, we also, I just want to ask you, do you feel that we could see the tide turning? Well, if you've really heard and understood what I've said, you'll be able to answer that question. At the moment, the buy sell ratio is at 0.66. So that it's at 0.66, which is higher than it was yesterday, which was 0.46. It's still pretty low. And that for what needs to happen is that needs to go over 1.0. We need to have as many buys, as many sells in order for a confirmed call to go up. But also as well, remember that it needs to rise week over week for 2 consecutive weeks. So at the moment, I don't see, how we could be in a confirmed up call position by the end of the year unless things change quite significantly. But you never know. That could be the case. But as I say, based on Wednesday, 21st, like the markets today in the US anyway, are looking pretty healthy. The Nasdaq is up 1.7%. Dow Jones is up 1.7%. The S&P 500 is up 1.68%. So all of those are looking pretty healthy. But of course, remember that we're just after a lot of red lights and a confirmed down call. So we are coming off that base. So I wanted to start off here by just giving you a sense of where we're at the moment. The MTI is below 1 with a slight turn, still below 1. We also have a confirmed down call when we look at the market timing indicators, and specifically when we look at the color guard. And even more specifically, again, we're in a confirmed down call, which is the most conservative market timing indicator of VectorVest. And then from a short-term basis, we are at a moment of indecision in the market. We've got 3 yellow lights. That is because of what I just described to you, is that it's been a tumultuous past couple of days, particularly since the Fed made that announcement. But today there's quite significant upsides there today of 1.6, 1.7%. That's where we're at a moment of indecision there in the markets. Now regaining an upside movement again, or that just washing out the good news before it gets back to the red. That remains to be seen. And of course, if you didn't have me here to talk you through all of that, again, let me just really simplify it down. The market timing indicator, above one is favorable, below one is unfavorable. The confirmed calls up is up, down is down, so it's a bearish conservative signal. And then in the middle here, we also then have the color guard, which is telling you that we're at a moment of indecision. It's neutral. VectorVest does not advocate buying stocks at this time because we're just after all the red lights while we're seeing an upside today. So that's why it's at a moment. Okay, now that is where we're at live on my laptop here on the 21st of December 2022. Now let's look at what is in store for the year to come. Okay, well, I'm going to start off here with a piece from US News. Okay, and this is looking at stock market trends for 2023. There's four in here that I thought were going to be of particular interest to you before I then move on, and I'm going to show you, of course, in each case how we really test this out. So the trends that they're putting forward are elevated inflation, rising interest rates, slowing economic growth, and the importance of stock selection. Now, you could have put all these three together. Elevated inflation leads to rising interest rates, which leads to slowing economic growth. You could have put all of those three together. And this piece does a particularly good job of bringing together all of the figures that is underpinning those statements. But what I want to do is I want to explain to you why this one freaks out investors. Let me just explain that to you for a moment. Okay, so let's just take a moment on this. Okay, let's say I'm an investor, and which I am, and I'm an investor, and let's say that over the past 10 years, I wanted to save money. I didn't want to invest, I wanted to save money. I wanted to put money on deposit, or I wanted to lend money to a government, a developed market government, and as a result of that, I wanted to make some return. Could I? Well, the answer is likely no. Because if I put money on deposit in a bank, I was likely to get negative interest rates. If I was lending money to a government through a government bond, the likelihood was that I was getting a negative return. One way or the other, the likelihood is that I was not going to be able to get anything. So what do I do? Well, the only way for me to make return then is to take greater risk or to go further into the longer term. If I put money on deposit for a longer period of time, then let's say instead of saving my money for 1 year, I might save it for 3, 5, 10 years. And if I was willing to lock up my money for that period of time, which itself is a risk, then I may have had a chance of making a return. But no matter what, it would have been minimal. And the reason for that is because interest rates have been extremely low. And the reason for that is because inflation has. So what central banks have been tasked with doing is keeping inflation at or below 2%. That's the ECB's mandate. Fed is slightly different. Fed needs to look at both full employment as well as putting the two together, as well as inflation. So it needs to keep a lid on inflation. Bank of England the same. It needs to keep a lid on inflation, etc. So over the past 10 years, central bank has been doing their very best to create inflation. If I was to go back a decade in the US, about 8 years in Europe, we were in an environment of deflation. Deflation is when the prices are falling. I'm going to introduce a new term now in a little while. But deflation is when you're seeing prices are falling. So of course, what's the problem with deflation? Well, the issue is that if I am seeing prices fall, let's say this cup of coffee, right? Okay, no, not the coffee, the cup. So here's a coffee, right? Here's a coffee cup. And let's say that I am somebody where I'm buying a new house and I want to buy coffee cups. And I see at the moment they are $100 for a pack of 12. And they're really nice. But last month they were $120. Well, and I know that maybe next month, because of January sales, they might be $80. The problem is that I will not buy them and I will wait. Deflation, of course, creates an environment where it actually people then withhold consumption. And then, of course, the person selling the coffee cups then might need to actually discount the prices even further to accelerate what actually happens. It's really difficult. Deflation is really, really difficult. So what did the central banks do? Well, they opened up the checkbook and they simply created more money. And by putting more money into the system, what that's supposed to do is then you creating more money, chasing the same amount of assets that is supposed to lift up prices. How did that work out? Well, if you actually think about what exactly they did, take money at the central bank, what they did was they bought government bonds. Government bonds, of course, are very low risk. That pushed up the price of government bonds, which meant that you and me, we wanted to buy them. They then became far too expensive. We weren't going to make anything. Like, we weren't going to make anything at all, maybe a negative return. So what that does is that it pushes risk up. So therefore, what you and I, or the institutional money, would have needed to do is then move on, let's say, and buy corporate bonds. And then the same thing happens. Then the prices of corporate bonds go up. That means companies or corporates can borrow money for very, very little. And that's a real help, of course, to a company because then they can borrow money very, very cheaply to invest, to build productivity, perhaps give to staff, to expand, take more risk, to take on more innovation, to buy other companies, you name it. And that happened. But then what happens is that if you want to move away from debt, you want to move into equity, well, then that money then also pushes up the risk. So what we saw was actually really significant inflation in share prices, but not in the price of coffee or goods and services. That wasn't happening. However, the central banks continued with a view to making inflation happen. And then in 2020, something, of course, named the lockdown, the global pandemic. And then what happened was because let's say I'm the person running the coffee shop, I could no longer sell coffee or the cups or the coffee in the cups. As a result of that, then government stepped in and money was given to everybody to be able to. Well, sorry, no, it wasn't given to everybody. Given to certain people, people who became newly unemployed, businesses who could now not operate. You know the story here. So actually, that ended up being a very significant stimulus into the economy. Then, when people could actually spend their money, or else when they weren't spending on certain things, then they moved it around to other things. And in 2021, what we heard was temporary inflation. This is what we started to hear the term inflation was coupled with the word temporary. However, it wasn't temporary, was it? It wasn't temporary at all. And then as the year went on, round about August, September, the word temporary started to be dropped from the press release from the coming from the central banks. And then of course we moved into the era of higher interest. Now, I'm almost there thinking about the investor now, right? Because bear in mind, if we go back to comparing me, the person who wants to put money on deposit or lend it to a government, pretty low risk. Think about where I've been for the past 10 years, right? I've gotten nothing. So all I could do was take more risk or do nothing. One or the other. One or the other. We're going to soon come back to me now. So as the year has gone on, of course, in 2021, we then dropped the word temporary. Inflation became a thing. And as we started into 2022, this is what we were all talking about last year, saying the name of the game was inflation. And that was where we were really going to feel it in 2022. Now, what happened in March? What happened in March? Well, in March, of course, then we had the invasion of Russia into the Ukraine. And along with that, then came economic sanctions that were put on Russia. But in particular, then what we started to have was energy warfare in its own way. I saw from the State of the Union address that Ursula von der Leyen had to her recent one in October, and she pointed out a statistic that in previous last year, 40% of our energy gas came from Russia. Our being in Europe's in 2022 is now down to 9. So we have seen a really significant increase in energy. And of course, since it takes energy to produce food, since it takes energy to move things from A to B, since it takes energy to do a lot of things, it is itself cost of an input. Like, let me just compare this slightly now with another element that we could look at in inflation. Let's say there was massive, eye-watering, like everyone's talking about inflation in education. Who would that affect? Well, it would affect people being educated. Of course it would. And it would have a disproportionate impact on families and on students. And I could go on here. But actually, energy affects everybody. It affects everybody because every household needs energy. Every food that is produced needs energy. Every time we get in our cars and we move from A to B, we need energy, etc. So this inflation in energy, of course, then creates its own. That's what we've seen throughout. So what do you do as a central bank? What do you do as you see inflation then creeping up to 6, 7, 8, 9, 10%? There is higher inflation now in the world, in Ireland, in Europe, that I have ever lived through. ever lived through. We would need to go back to the 70s, early 70s, before we could talk about the same level of inflation as we are now. What do you do? Well, as a central bank, of course, you increase it. Well, if you increase interest rates, is that actually going to have the effect? Challenge. Because is that actually going to have an effect on price of energy in particular? And as we can see, it has not, because inflation is still as high as it is. Now, we have seen slowing inflation, but we've also seen slowing economies. And this is the hard part to watch, because I'm both an investor and an economist. It's been a hard part to watch. Hard part for anyone to watch is because we're seeing now central bankers creating recessions, creating recessions because their mandate is not necessarily economic growth. Their mandate is price stability. At or below 2% in the EU, Fed, Bank of England, etc. It is their mandate for price stability, not. So what we're seeing central banks create recessions. That's ultimately what, and we can see it continuing. And like I mentioned, why we're seeing a confirmed down call now is because that rhetoric is continuing. So let's go back to me. Let's go back to me, the investor, who, as I said a decade ago, I had nowhere to go. I had nowhere to go as an investor who wanted to put money at very little risk. In essence, you could call me a saver. Well, now and soon will, because now I can lend to governments because we've seen bond yields go up. Now there are much lower risk and much, relatively speaking, higher returns available from those lower risks. We can see that now. Right. So before I might have been in the stock market against my will, either that or just leaving money on cash, also against my will. Now I can put it somewhere at relatively low risk, but where there is significant enough return to compensate me. The second thing is that I no longer can afford to put, if I have a significant cash balance, on like doing absolutely nothing because of the pace of inflation. Today, if I have €100 in my pocket today, that €100 today is likely to buy round about the equivalent of €92 of what last year's €100 would worth. Now think about that if I had 100,000. Think about that if I had a million. Think about that if I had 10 million. So therefore, inflation is now pushing people to say, what are you going to do to put your money to work? Because inflation and thus purchasing power is really digging into it. And then, so that's me, right? That's me, that initial. But think about me now, the middle of the road investor, right? So yeah, I'm happy to go into the stock market. No, I am. I understand. And I might be somebody who's quite conservative. So I'm quite happy to go into the stock market if, let's say, I can buy a basket. If I'm buying very high dividend yield, if I can get a significant income, and that income is from stocks that are pretty, sustainable type of dividend. Brilliant. Happy days. However, take that very same person and let's say they're able to get a yield, which it doesn't have, has very little risk of 3 or 4 or 5% from a developed market government. So they don't have the volatility of stocks. Yes, they don't have the upside either. They don't have the downside. This is the thing, is that that person now has more opportunity, more incentive to lend money to those bonds or to invest in those maybe more conservative stocks. But let's say particularly looking at those kind of low risk sort of bonds. And there's your problem, is that both of those characters have now left the building. They have now left the stock market, and we don't have the central bank that is putting new money into them, which itself then is going on and buying up government bonds, which then is moving up towards corporate bonds, which is etc. So we actually have really big, significant buyers moving out, moving out. And then, of course, you have those people who do understand, like me, the risk of the stock market, who does have a long term horizon, like me again, like somebody who is happy to invest with the knowledge that there will be volatility, of course. But then you see a confirmed down call. Or then you see that the tech sector has had what it's had. And then you think, well, you know what I'm going to do? Wait this out until all of this kind of washes itself out, then I get back. And that is why higher interest rates, that's what investors, that savers are going to put the money where. You no longer have central banks boosting things up. You've got your middle of the road conservative investor could now become more of a government bond investor. And then you have people who are willing to invest, but not into it. And then you've got, and then of course you've also got the money that's already in the. So when you put all of that together, that's where we stand. Like that's where we stand on the 21st of December 2022. That is where emotively people are standing making decisions. So when it comes to that particular piece, that was what I wanted to show you, is that elevated inflation, rising interest rates, and slowing economic growth. That's how the whole package all fits together. Now, like I mentioned, there's a lot of really great figures in here, right? That's well worth that's well worth the read down here. And by the way, also I see the team there had put up the link in the chat if you want to stay connected. Of course, anybody who is on that mailing list as well will get my follow-up email and all of the resources that I'm. So um just make sure and sign up there if you would like to get that. So if I but I want to draw your attention to two numbers. The bond market is currently pricing in a 52.7% chance that the Fed will raise interest rates by at least another half percentage point by March 2023. So at the moment, that's what we're looking at, is a more likely than not possibility that the Fed will raise rates, and by half percent by March 2023, which will again increase the floor at which you can put money on deposit or lend money to a government at a higher return with relatively little risk, depending on where you're going, of course. But this is what investors see. Now, the only thing I just want to draw your attention to is this piece makes the point that the importance of stock selection has grown. And that is because in a weakening economic environment where you are dealing with a market that may be going into decline, and I'm going to show you another point on that. But in essence, things have changed. Energy is now low beta. Beta is its responsiveness to market return. So, along with financials and industrials, after sporting higher betas than every other sector for the prior decade. So that means that energy now moves, energy stocks moves in a different pattern than the broad market. And that has changed. And remember why? Remember why is that in many ways, energy inflation is not only going to be influenced by central banks or indeed economic growth or indeed demand, but big issues that's happening with supply, given the fact that how much of this is wrapped up in a war zone at this stage. And just finally down here, despite the potential for major volatility, Wall Street analysts still see overall upside for stock price in 2023. The average 12-month S&P 500 analyst price target is about 4,406, according to FactSet, suggesting about a 16.7% upside from the index's value at close on December. Now, I have a very simple way of looking for those stocks that have the best value, safety, and timing opportunities, and that is click on viewer, click on stock viewer. Da-da-da-da. Okay, here we go. This is the simplest way of bringing up to the top, VST descending up to the top, the best combination of value, safety, and timing. So this is the best combination of stocks that have good relative value, which is long-term price appreciation potential, relative safety, which is consistency and predictability of financial performance, and D, which is relative timing. That looks at the dynamics and the direction of magnitude and direction of a share price. Now, every year I take one opportunity to test out that theory, because my theory is one of the simplest and most effective things I could do in VectorVest is based on the confirmed calls. So buying on a confirmed call and then buying on the top 10 stocks in terms of VST, then selling when we get a confirmed down, going to cash and repeating all of that again. I ran that experiment. I do it every year. Every year it's worked. And I want to show you, views home. I ran this as a test last in here. This is exactly what I did. In the approach, only buy stocks when the confirmed call is up, sell stocks when the confirmed call is down, on a confirmed up basis. In simplicity, the annualized return in the European market is 22.83%, and that is, of course, much higher than the average that we've seen in the past 100 years of between 12%. The maximum drawdown was 29.21%, significant. But of course, I didn't put in any stop losses on any stocks, which of course I could have done. Even if I had put in a 20% stop loss, 25% stop loss, you might have seen something. And of course, the other thing, and I always point this out, that I, on that basis, would have lost money on more stocks than I would have gained. But on the ones I would have lost money, it would have had far less of an impact than stocks that I gained more. And so this here is the last number. I'm always intrigued that every time I've run this test, fewer than 50% of the stocks have been winners. On this occasion, it was 46.85%. As usual, the point is driven home that you don't have to win all the time. You don't even have to win most of the time. You simply have to win more than you lose. So that was in my views last week. Any of you that has VectorVest Europe, which is everybody who has VectorVest at all, you can see my views on that. Okay, let's now move to the next piece that I wanted to bring you towards, and this is JP Morgan. JP Morgan stock market outlook is this. It says that after a year of macroeconomic and geopolitical shocks, both of which I've discussed with you all, investors responded by derating the S&P 500's S&P 500 PE ratio as much as 7 times, while some speculative growth segments crashed 70 to 80% from highs. I think you all know the stocks they are referring to, and there's no allude to they are. So then the piece goes on to say, although fundamentals have been resilient throughout these shocks, this year's constructive growth backdrop is not expected to persist in 2023. Fundamentals will likely deteriorate as financial conditions continue to tighten and monetary policy turns even more restrictive. So that is what the bond market is pricing in. Monetary policy is interest rates, exchange rates, and the money supply. And we know, as we've already discussed, the Fed is looking at not printing more money and putting it in the system, but also, of course, continuing to grow interest rates, as is the ECB, etc. Now, it says fundamentals. So what are fundamentals? Well, fundamentals are earnings, in particular, as financial conditions continue to tighten. In other words, the price of money goes up and economic growth does not. So it says the economy is likely to enter a mild recession, the labour market contracting and unemployment rate rising to about 5%. So that is what the name suggests. We see fewer people. Now, I just want to draw your attention to this in particular. In the first half of 2023, we expect the S&P 500 to retest the lows of 2022 as the Fed over-tightens the weaker fund. In other words, the Fed goes too far. This sell-off combined with disinflation, this is the term I said I wanted to you. Deflation is what I mentioned earlier. Deflation is when prices go down. Inflation is when prices go up. However, disinflation is when you have slowing inflation. So prices are going up, inflation is going down. Think about that now for a moment. Disinflation, so prices are still going up. Inflation is still happening, but at a slower pace. That is what disinflation is. And we've already seen that in Ireland, for example, the inflation rate in October was 9.2%. And I think in December, it was down. I think it went from 9% down to 8% before the decimal point. If I'm right, I probably should get my numbers to be perfect. No, let me get the number. Get you the CSO right now. Yeah, 9.2% between October 2021 and October 2022, whereas in November it was 8.9%. Yes, there you go. This is what I had wanted. That the CPI, the Consumer Price Index in Ireland, rose by 8.9% between November 21 and 22, which was down from an annual increase of 9.2 to 2020 October 2022. The difference here is we still have inflation, very significant inflation in Ireland, but this number is lower than that. So that is disinflation. Inflation is still continuing, but it's slowing down. Inflation rate is coming down while prices are so this sell-off, combined with disinflation, rising unemployment and declining corporate sentiment should be enough for the Fed to start signalling a pivot, pushing the S&P 500 to 4,200 by year-end 2023. Now, remember what I said earlier, separate news from noise. So what I want to do is show you how do you find the stocks that have got the more resilient fundamentals? Well, the answer to that is this one, RS. RS is relative safety. Relative safety looks at a stock's ability or a stock's consistency and predictability of financial performance. So if I was to look at any of these companies, United Health Group or Progressive, or obviously I would see a sell recommendation there, so that may not be meeting my criteria. No, a sell criteria has nothing got to do with relative safety. This is a sell because the price of 708 is lower than the stop price of 235. That's the reason that has a lower that is a sell recommendation. So what you can see here is that what I've done single-handedly in one click of a button is that I have now ranked the entire 9,143 stocks that we have. I've now ranked those in terms of relative safety, consistency, and predictability of financial performance. If any of you want to learn more about that, I could show you. I could right click on any stock. I could view the full stock analysis report. Scroll on down, and down here, there you go. RS is an indicator of risk. RS is computed from an analysis of the consistency and predictability of a company's financial performance, debt to equity ratio, sales volume, business longevity, price volatility factors. So that is what consistency and predictability of financial performance is built on. If you want to know more than that, well then, and actually I might just say, can I just ask the guys there back in HQ, would you mind just putting the link for the trial into the chat, please, so that anybody who wants a trial of the software can go ahead and take a trial. And of course, you can test out everything that I'm talking about here. But over here in the training tab, I was looking in the wrong spot. Over in the welcome tab, you can also download Stocks, Strategies, and Common Sense. It's an ebook written by our founder, Dr. Bart DeLido. And in here, there is a whole chapter dedicated to relative safety. So just wanted to make the point that if it is the case that due to the weaker fundamentals that are in stocks, on a broad basis, you want to find stocks, going back to the last piece, because of the importance of stock selection, then in here, this points out the relative safety can bring those stocks very much to top of the tree. Okay, now as we move on into the next part of our episode, what I do want to mention is this piece. This was a conversation that was had by Bloomberg Live. It was had on the 7th of December. Now, it's about 24 minutes long. I have to say it is pretty good. Mm-hmm. It is pretty good. It's worthwhile listening to. And I'm not going to play it for you, obviously, because I'm here, but I do want to summarize 3 key trends brought to the table. Number one is exactly the same as what I said last year when I was delivering this episode. It's pretty much exactly the same, and that is that there is a continued hunger. There is a continued hunger on the parts of consumers and also on the parts of investors for ESG. There is a kind of growing continuation of that all the time. Now, it has filtered in different ways. There has been an increase in AUM, assets under management. We've seen an increase in AUM in ETFs focusing on ESG and in other types of funds as well as in conversations. There's more and more demand for that and more climate action. So obviously, I said this last year, I'll probably be saying it again next year. It's a continuing trend, but that's news to nobody. What I felt was quite interesting in this piece as well, in this panel discussion, was one statistic brought up which I thought was very interesting, despite what I've just said to you. That is, they quoted a statistic that in order for us to have the infrastructure that we need to have a carbon neutral economy and so on like that, there needs to be a 4-to-1 investment between investment in green energy, investment in fossil fuels, right? 4-to-1, 4-to-1 green energy. At the moment, it's 1-to-1. And one of the issues that is causing a problem for investors at the moment is there isn't enough to invest in. There actually is too much money chasing too few assets. So that is also another trend that is expected. Like that's again something that has become quite prominent in discussion in recent times, particularly among institutional investors and those investment products that are available. So that is another change that we would be expecting. Now, I would just also want to show you this. I just found this is very interesting as well. If I take a look at wind energy in Ireland, I know I'm talking about Ireland again, but let's just look at this again. This wind energy. This is it. Is that 48% of Ireland's electricity came from wind energy, November 22. And I've looked at this consistently throughout the year. So in order for a country like ours to be able to power itself without the reliance on fossil fuels, then of course it needs more and more investment in green energy. But I'm just interested that this is the highest ever. And also, wind was Ireland's number one source of electricity in November 22 and in October 2022 as well. In fact, third of Ireland's electricity in 2022 come from wind so far. And it's the most power ever provided in the month of November from wind. So the movement is happening there, all right. But is there enough ideas? Are there enough projects to invest in? Based on the conversations that I heard on this particular piece, the answer is no. And that's going to have to be changing. Now, the last part that comes up in this, there's a range of things that they do discuss here. Like I say, well worth listening to, but I just want to summarize it down. The other point that comes up as well is part of the reason why Europe is leading the way when it comes to ESG. And that was one of the reasons that I put forward this show in general today, is because I felt Europe was leading the way. And that's why I wanted to lead the show, is because I live in Europe and I'm immersed in all that's going on in it. And within that, what we see is that ESG and climate and investing of this sort has now been embedded into regulation. So now part of MIFID is there's now a question to ask to people in that get to know your customer, KYC, know your customer, that around do you want to factor in ESG, want to factor in these types of conversations or these types of considerations into your investing decision making. So since it's more, if it's embedded into regulation, if it's embedded into the system, it's embedded into processes, it's less of a choice. And of course, if it's, and that's to protect, regulation generally is to protect people and things. So if it's embedded in there, of course, it's naturally going to have more of a focus. So they're just three trends that come up. Number one is there's demand. They mentioned a statistic here: 80% of investors want companies to factor in green and climate and ESG in general into their decisions. Number two is the one-to-one investment between green energy and fossil fuels that needs to rise to 4-to-1. Third one is that Europe is expected to lead the way, particularly because of how it's embedded into regulation. Let's move from there to technology. I thought I would bridge the two together. Here we are. Okay. I would bridge the two together so that I would look at sustainable tech trends of 2022. So there's 5 here that they picked up on, which I think are going to be very interesting if they can actually be delivered upon properly. One of the reasons that I hear people not choosing an electric vehicle is because of the time that it would take to charge the car. Now, electric vehicles have been on the road now for quite a significant time. I know myself, there's a lot of people around me either have EVs at this point or they have hybrid. And the number one reason that I hear why people don't is it's nothing to do with the money because, well, nothing to do with the income element or not the income, the operational expenses, because it's much cheaper to run it certainly is where I'm from anyway, much cheaper to run an EV than it is to pay for diesel or petrol, particularly with the rise in energy prices over the last while. However, of course, it can be a more expensive car. Economics aside, the real issue is how long it can take to charge. And that's why, while filling a tank with gas can take only about 5 minutes, depending on the specification and size, the fastest charging stations can take 30 minutes to get to a battery of 80%. Now, I do not have 30 minutes to be waiting on the road. However, researchers from Penn State University have published a study that they can charge to 70% in 10 minutes. That would be a game changer. So that is one. Another one here, another interesting one, and that is that solar panels, the idea of capturing the sun's energy and turning it into action, of course, is great, but where do you put them? And Ocean Sun, a Norwegian startup, is exploring the promising future of floating solar panels, which makes an awful lot of sense since we have so much of the world covered in water. That would make a lot of sense too. Disposing of electronic waste. This is a way in which that you can turn waste into an output of some sort. Can also make a massive difference. It makes a brilliant business model as well. That is another one that is coming up here. I think this one though is quite interesting. I don't quite see stocks necessarily, listed companies being able to make a big difference in this area, but I do see startups and particularly consultancy services. So energy efficiency is a big draw for clean energy as it can help reduce monthly bills and save companies money. But technology needed, like wind turbines and solar panels, and dauntingly high upfront costs make companies nervous. If you could simply pay for energy efficiency as a service to be able to come in and look at how the company is being run, reducing their cost, and as a result, then increasing their energy efficiency as a service, then of course that may accelerate the capability of companies to deliver upon that. Like I say, I see that more being for consultancy companies than any of our listed stocks turning their attention and really making a massive go of this. But and then also electric aviation now. When I was reading this, I thought, whoa, talk about not having time to stop for 30 minutes to charge a car. I certainly don't know how I'd feel about getting on a plane and flying, let's say, over to the team in Ohio from Dublin and hoping that there's enough fuel in the tank. So the aviation industry produces 2.1 of all global anthropogenic carbon dioxide emissions and is responsible for 12% of transport related carbon dioxide emissions. So as electric cars are becoming more popular as a way to reduce transport pollution, it's not surprising electric planes are the next development. Rolls-Royce, indeed, successfully completed a 15-minute flight of its first all-electric plane in the UK at the end of 2021. An Israeli startup, Eviation, successfully completed an 8-minute of their battery-powered prototype in Washington State in September. And while that is great, guys, it takes a lot longer than 15 minutes to get to Ohio. So they're just some areas that I thought might be of interest that we'll be keeping an eye on from combining ESG and technology together. I want to finish up today in my last couple of minutes with a well-known character in this world, namely Jim Cramer. And Jim Cramer has 7 stocks that he believes will perform well this year. And there's going to be a lot of talk now over this next while, a lot of talk around what people are predicting for the year ahead, or what, even look, I'm part of it myself, the fact that I have this episode where I wanted to talk about the trends that I think are going to be very influential on the year ahead. So as you see that, you may see things like this. CNBC's Jim Cramer on Tuesday gave investors a list of stocks he believes will perform well next year. Is that let's now go and put these to the test. And I want to show you how to do that. So what I'm going to do is I'm first of all going to go to viewer, go to watch list viewer, and I'm going to put this in under my watch lists. I'm going to create a new one. I'm going to call this Jim Cramer's 2023 recommendations. Okay, and I'm going to say we discussed this in the Tech Show 2022, December 20. Add. All right, now let's populate our list in here next. So we have Eli Lilly, Humana, Humana, Humana. We have J&J and Caterpillar. Now you get to know the ticker codes after you're in this business for a while. Caterpillar, yeah. Caterpillar, Deere, TJX, Deere, X. Right. Here we go. So let's take a look. Okay, well, out of his 7 stocks, 5 of them have a buy recommendation from VectorVest. 6 of them have above 10% growth expectations of their earnings. Average dividend yield is 1.39%, so quite a growth selection. We have all of them are rising except Humana. I can tell that because of the one. All of these have an RT above 1, Humana doesn't. Relative safety, all of them have relative safety above 1 except Caterpillar. Interestingly, all of them, all of the stocks here have a VST above 1. We're all up today. But then again, a lot of things are up today. So that's not all that noteworthy. On average, we can see a relative value of 1.06. This means the stocks have a price appreciation potential of 1.06. Eli Lilly, TJX, and Johnson & Johnson all have an RV below 1. Looks like if I look at Eli Lilly here, for example, it's trading at $369. VectorVest value is deemed to be a lot lower than that. Now, that is just one measure, but it's the relative value what is intriguing me here. That said, I would expect the dividend yield of these companies. Yeah, I mean, look at these dividend yields here. Then we're looking at if it we've like for Morgan Stanley to be giving you 3.55%, very significant dividend yield here of Caterpillar at 2%. So when I looked at the 1.39% there, that's particularly being driven lower by Humana. But some of those are really quite significant, particularly Morgan Stanley's. Rare that you see that these days. Now, one metric here would concern me about this. I think it'll be interesting to watch this, and that's this one. That is the CI. Now, the CI is a stock's ability to withstand fear and/or lengthy price declines. So all of these CIs have been well below 1. I mean, particularly here we've got Johnson & Johnson 0.54. So let's take a look at that graph actually. Take a look at Johnson & Johnson. Okay, that's a year. And I bought last year at 167. I mean, I'd be smiling now because it would be one of the few stocks where I would have been up and up. What is that? Up, well, up a little bit in the year. Let's go to 5 years though. Okay, so J&J 5 years ago, 147. Slow and steady wins the race, doesn't it? When you're looking at a stock like. And what I'm wondering though then is 5 years, add in. Ordinarily, I describe the CI as starting at the bottom left and top right, which is broadly speaking the case. I mean, it has been choppy over the past year, but the choppiness has been in many cases been not very long. And look here at that. It's either been a buy or a hold. Sell recommendation here when everything was back in, I think that's March 2020 when everything was buy, hold, buy, hold, buy, hold. So that is what I do when I see something like Jim Cramer has picked out these 7 stocks, is that I put them into a watch list and I look for what I'm interested in. What I'm interested in is I want to see the growth potential. I want to see whether it's buy or hold or sell. I want to take a look here at its relative value, its relative safety, its relative timing, what stocks are offering a dividend, and then asking what stocks offer a dividend yield. And then I investigate some graphs after that, like I've done there with Johnson & Johnson, and I always take a look out as well for CI. But as I'm looking at individual stocks, compare the individual stocks then to the overall watch list average down. And so this brings me to the end of this episode where we wanted to take a look into 2023. And in summary, we are looking at an environment where we are looking at rising interest rates driven by inflation. Central banks have less influence over it because we can see where it's coming from. And sorry, before we go that, Ashok says, Susan, in the MTI chart you showed initially, does the set of three peaks in late March, mid-July, and December 1st look like a head and shoulders pattern and downturn in the market? Okay, so Ashok, the way I would look at that is looking at, remember, we are in a confirmed down call, right? So from a VectorVest point of view, when we're in a confirmed down call, that is the most conservative signal given. And as a result, there would not be a further signal given. Now, I always, if you want to keep looking though, if you want to keep analyzing, number one, when is it oversold, or when could it turn? The BSR is an interesting to look at. That's the one I showed you at the beginning. BSR is buy, sell, ratio. I've seen that BSR go to 0.01. In Europe, I remember back in 2011, it went to 0.03. That meant for one, every sell recommendation, it was 0.03 buy. That'll tell you that's seriously oversold. Anytime it goes below 0.2, that is when the market is looking like it's. So what I'd say is, I know what you're talking about from a technical point of view with the head and shoulders, but as regards VectorVest communicating anymore, is that it's now in a confirmed down call. That is the most conservative signal pointing out towards bearishness. And therefore, if I was of that ilk, I would not be looking at investing in the market until firmed up. But if I was short term, of course, like you see today, there's significant upsides happening. In fact, in the past hour, let's just hop over there very briefly, and I'll finish that, everyone, I promise. But let's just look there since the beginning. Yeah, I mean, the market has tapered off now again. You can see that our confirmed, or our MTI is starting to lose its way there again. But look, the S&P is now 1.37. That was at 1.68 at the start of the episode. And the Nasdaq was at 1.7, 0.72 at the start of the episode. So you can see there that even at that now, it started losing some of its mojo since then. So that is what it's all about. That is what it's really important to understand. If you're looking for a signal, when are you going to get it? And like I say, at VectorVest, we're in a confirmed down call. So there isn't going to be another more bearish signal. And on top of that as well, remember the MTI is below on a long-term basis. Short-term basis, I would be looking at it from the color guard. So, in summary, we're looking at inflation, disinflation, but inflation nonetheless, significantly so. Rising interest rates are being priced in, more investment into ESG. Of course, what people need to do is always consider the vestibility of ESG strategies. And I always think, I remember when I started studying in this area first, people did not talk about ESG then as anything that could be simultaneously investable. That's not the case. You can do very well by investing with ESG and profitability in mind. But I think the opposite also needs to be the case, which is that if you're going to invest in ESG, it needs to also demonstrate its profitability. And of course, whether it's greenwashing or whether it's any of the other cynical stuff that's going on out there, it has its place. And that is, I think we also need to make sure that when bonds are said to be green, or stocks are said to be green, companies are said to be fulfilling green practices, is that they follow through. Now, John says, when the BSR goes that low, you never want to buy, but that time is a great time to buy SPY or QQQ calls for 12 months out. Interesting point, John. I would say that when the BSR, again, the buy sell ratio goes that low, that is not necessarily a time to buy. It is a time to point out that the market is oversold. I saw the BSR being low quite a significant period of time. I only started in VectorVest as well at the time. It's August 2011. And the I saw that BSR being quite low. So I always make the point, it's not a buying signal. It is the market is oversold signal. What you needed for the buyers to push the sellers up for seeing your buying signals. And of course, again, they're communicated through the market timing indicators and the confirm calls, etc. So thank you all so much indeed, not just for being with me here during this episode, but for being with us here at the ESG and Tech Show right throughout. Massive thank you to Joey, as always. He's always the person who does the tech check, and no matter what problems I bring to that man, he's well able to handle them, no matter what they are. So I just really want to say thanks so much indeed to Joey. Thank you to all of the team, to Clay and all of the team, VectorVest, to enable this show to happen. Thank you, of course, to all of you. The fact that you're here makes this show a possibility and a reality, and we have lots more in store for you. Have a super lovely Christmas, everybody. I will see you in the new year, And until then, have a happy holiday.